This is Ryan Long. I am here to tell you what is up with the national real estate market here. It's early 2025. I just got back from a conference about real estate. I want to share you some of the more exciting parts of what I learned at the conference. I'm going to pull up some slides, go through them, take a few minutes, and I'm going to go through them fairly quickly. Feel free to pause if you want to zoom in and check out some of the statistics. I'll tell you what my ahas were from this conference and from this economic presentation. I distilled the slides from like 80 down to probably 20 or so. So just the things that I thought were most interesting. Let's take a look here now. All right, the first thing is a data disclaimer. This is as best information as we have, no representation or warranties, blah, 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 all that good stuff here. All right, the first is just looking at general home sales numbers here in the United States. We are seeing over on the right-hand side, hopefully you can see the screen here, that last year we had 4.1 million home sales in the United States. This year is not that much higher at 4.2 million home sales. Kind of interesting. This graph does go back, it's 25 or so years. So you can see the early 90s here. You can see where we topped out right before the Great Recession, and hey, maybe that's what caused it. But 4.2 is a very relatively low number, especially going back 20 years here. During the pandemic, we were in the high fives and low sixes. Our second slide is home prices. This is probably the most interesting slide in my opinion, my humble opinion here. What we're looking at is the median sales price in thousands for the United States. 408,000 was the median sales price in 2024. You might be wondering what this light blue line here is. What we see as a long-term trend line of roughly 4% appreciation a year. Generally, inflation has been 2.5% or so. And so at 4%, your real appreciation rate after inflation is about 1.5%. But that's a big part of why prices go up. You can see that there was a time right before the Great Recession. There's the bubble here in 06 where prices got above it, went below. But in general, it's stayed very close to this 4% trend line. In COVID, we got above it again. And the projection in general is that we'll see roughly 3 to 4% increase over the course of 2025 to 418,000. Staying on the home prices, here's a look at annual appreciation. So the percentage it goes up or down each year. Looking at the 90s to 2000s, the 90s were a real good time. We had consistent 4% growth. We had the big run up for the bubble in 01 to 05. And we had the recession here, and you can see that each year it was actually in the negatives. And then we had some, again, pretty healthy, stable returns. 2012, 2019, we had our bubble again, and now we're figuring things out again after the pandemic. This is another way to look at home prices. We just kind of went over it. This also has some indicators and events that happened along the way, so you can see it a little bit more clearly as well. And this actually goes back to the 50s. So before we were looking at about half this chart, we're actually looking back even further, and shows the 70s here when there was real high rates in the late 70s. I'll let you look at that one on your own. Inventory. So this is annual months of inventory. What we're looking at is the home sales rate and really thinking about how many months of inventory or how many months of homes there are at any given time for sale if no more came on the market. Right now, we're at 3.7 months of inventory. So again, if no other homes came on the market, it's about 3.7. Here, we say balanced is about 6 months. This has come up just a tad since the end of 2024, but not much. We're seeing lots of healthy activity. So here's long-term trends, probably average, it's about 6 months, and that's what that dotted line is showing you there, a healthy, balanced market, basically balanced between buyers and sellers as far as who has the most negotiation ability. All right, mortgage rates, we're feeling the pressure of mortgage rates right now. Today, where we're sitting mid-March here, is about 6.5%, 6.75% for conventional rates. So it's down a little bit from the sevens we were seeing most of 2024 here. But yeah, you can see again, late 70s, early 80s really topped out a lot there. Long term, looking back, just over 50 years, we've seen high sevens has been the average over that time. Since 1990, the average has been about 6%. So historically, we're at a low interest rate. And even when we look at the last 30 years, we're close to in line with the averages. We were just extremely blessed there for the 2005 to 2020 kind of range with those rates. So interest rates here, this another way to look at the interest rates even more recently. So this is only going back 10 years, and you can see a little bit more granular detail about what's going on with interest rates and where we're at. Again, January 25, they were at 7. We've come down just a tad from that, a third of a percent or so. Affordability. So this takes a second to explain, but affordability is a measure of the percentage of income that the median American is paying for their payment and interest. So it doesn't include the full PITI. We're taking out the tax and insurance and just focusing on the payment and interest of the average priced home and looking at that for the average or median income as well. And so you can see the spikes here. 81, it was up to 49% of income. People were spending half their income just on, principal and interest as interest rates went so high. Right now, if you were to buy a home, we're sitting at about 32% average of somebody's income to pay for their home. But again, we were blessed in the 2010s here. Most of that time it was in the high teens or 20% there. I mean, gosh, but historically, we've seen closer to 20 to 25, 20 to 27%. So we're a little above the average here. Listings with price drops. This is threw this one in. I think it's interesting. Listings on the market traditionally will have price reductions, price drops, price improvements, as real estate agents like to call it, when they drop the price. And really the only reason to drop the price is if it's not selling. That must mean it's priced incorrectly for the current market. And so this is showing what percentage of listings have price drops at any given time. So this is going back just 2 years. Again, this was the tail end. Early 2023 was still kind of the tail end of our super hot, frantic market there during COVID. And then we saw it come up here, and we've been sitting there, around 30%. But this hasn't gone up substantially over the last, it's up a bit, but this is still not a substantial percentage of our listings. And pre-pandemic, we probably would have seen the same thing or a little bit more. New listings coming on the market. This is also just going back 2 years and showing in thousands how many new listings are coming on per month. You can really see the seasonality each year of listings as they come on the market. The bulk coming on April, May, June. And so, Corvallis, the Mid-Valley area where I'm based, is always, it seems like, about a month behind the national numbers for new listings, partly because our school year goes a month later than most school districts around the country, and our college is also based on that month later schedule going into mid-June. Distressed sales. So this is the percentage of home sales, so that 4.2 million that we're expecting this year. What percentage of those were distressed sales, meaning foreclosures or short sales, where somebody's having to get out of their mortgage because they, in general, can't afford it or don't want to pay for it, but mostly can't afford it. You can see the effects of the Great Recession here, 2008, and sliding down. But since 2008, it's been negligible. So even pre-pandemic, before the forbearance rules and everything, it was pretty negligible going into COVID, and we really haven't seen much of an increase. We might see very slight increases here as prices have stayed stable. So somebody that purchased in the last 2 years that's trying to sell today after transaction expenses, they might be underwater. But if you've owned your home for more than 2 or 3 years, almost for sure you're going to have some equity. That's actually what this is showing. So the percentage of underwater homes, the last data point I have here is the end of Q3 2024. You can see less than 2% of homes is underwater. As we go back, this graph goes to 2010. So again, kind of going back to the height of the Great Recession there, and you can see a quarter of the homes were underwater. That is absolutely crazy. So we're still sitting very pretty as far as housing not likely to create a recession. People have equity in their homes, and in general, that makes them more confident consumers as well. We do track the credit conditions, and so this is thinking through, are borrowers tight or loose with their money as far as lending standards. And so when we had the ninja loans, and it was, they, if you had a heartbeat data, they'd give you a loan. That was extremely loose credit standards, of course. So this graph is going, back to, again, right when the Great Recession started, because everything was happening and so many foreclosures were starting, people late on the payments, the credit conditions tightened considerably. Since then, they've gone up and down. Right at the beginning of COVID, we see this spike too. But, people often think, is it harder to get a loan now or then? And really, it hasn't changed all that much over the last 12 years or so. New home starts, so thinking about new construction, this is in thousands of units. So actually, this dotted line is showing 1 million units a year. This is going back 20 years, seeing how many homes are built each, or started to be built each year. And this is single family homes. We think 1 million is kind of a healthy number, or what the US generally needs to sustain housing inventory for the current population. That's why the dotted line is there. And what happened is there was excess at the beginning of the Great Recession. That was part of the problem. There was too many homes and many were vacant. But then we see it trail off considerably and probably got to kind of an even portion here in 2010 where it started building up. But unfortunately, we didn't have the homes built, so we're still running at a deficit. The news has talked about that quite a bit. 2, 3, 4 million units short still. But this is the reason why we had that deficit for so many years below that million home average that we should really be targeting in the U.S. Thinking about builders and developers, I thought this slide was interesting as well. Challenges and why we're probably see that new home starts decline a bit going to the next couple of years. Regulatory burdens, land, the cost of land is going up, volatile material prices, obviously with tariff questions and everything else. Prices went up during COVID, and really a lot of building materials haven't come down. Labor shortages, and how things pan out with even migrant labor that makes up a fair number of our construction workers and construction industry here in the United States. Profitability constraints, project feasibility. So again, there are some headwinds, we'll say, for builders right now. Home insurance, that's another huge factor for all of us homeowners, and just thinking, how much insurance goes up per year. So this is a percentage change each year. Homeowners insurance is always going up. I mean, if we look at long-term averages, year-over-year increase 2.2%, it's saying here on this slide. The last few years, we've been seeing that up in that 10%. I know we've all felt it, kind of expecting more of the same, at least the next 18 months or so, but it's anybody's guess. First-time home buyers, I found this slide incredibly interesting. So this is the percentage of homes sold during a given year to first-time home buyers. You can see, it was pretty consistent in the 30s to low 40s through much of the last 20 years here. 25 years, this graph goes back. The last few years have been incredibly small. It's just so hard. Again, the affordability. I mean, this probably tracks affordability pretty closely because first-time buyers, of course, are impacted more heavily with what they can afford. As affordability has gone down, first-time home buyers as a percentage has also gone down, which I think makes sense. Method of home purchase. This is interesting graph thinking about who's using, or what percentage of people are using buyer's agent and real estate professionals in a transaction on, again, this is from the buyer's perspective. Before, when there was more new construction, we can see that orange was a higher percentage. That's people that bought directly from a builder. The purple section is what percentage are purchasing from the previous owners, for sale by owners, or maybe a transaction between family members or something like that, friends or family members. The percentage of buyers that use buyer's agent, though, has stayed pretty consistent over the last 20 years. I mean, close to 88, 89% pretty consistently. Methods used to sell a home. So this is the other side of the coin, right? This is the people selling a home. Did they use an agent? Did they for sale by owner? What did they do? And by and large, 90%, about the same percentage, are using a listing agent. And that number has actually increased. So 2006, even from 2010 on, that number has only increased. Or remember 20, 25 years ago, everybody's saying, real estate agents are going away. We can look at homes online. But to be honest, most people want a trusted professional to help them through for many cases, the biggest purchase of their life and their biggest asset. In this case, selling that asset, making sure they're getting the highest returns for it. Hey, if you stuck around with me, I appreciate it and hope you learned something. And again, this was some of the highlights from a 2-hour presentation. So hopefully I condensed it down to the most interesting stuff here over the course of the last few minutes. Appreciate you sticking with me. If you have any questions or want to nerd out on real estate economics with me, give me a call, give me a shout. I can share some of my favorite podcasts and books and where I'm getting my sources outside of our Keller Williams conferences. Thanks so much.